Good afternoon, everyone. Welcome back to our weekly market review show. Today, I have my co-host with me, Mr. Gerald Wong, over here with me. So, how is your weekend, Gerald?
Hi everyone. I'm Gerald. Yes, the weekend was good. Quite interesting because I was actually running around the stadium when I was doing my usual weekend run. So managed to see all the excitement about the Taylor Swift concert, as there were many people who were gathered around the area.
Wow, I think must be very interesting there to see all the Taylor Swift fans around there with all their dress up and the
Bracelet.
bracelet, yeah, the friendship bracelet. But then on the more serious things that happened last week, we have some of the key economic data that came out last week, the non-farm payroll data, as well as some key comments from the central bank chief. Jerome Powell said that we are not too far off from having confidence to start the rate cut cycle. And ECB president said that they maintain the interest rate at 4% on the ECB side, and they are saying that in June when they have the first quarter the wage data, they would have more power or more clarity to dictate how things will go further for the second half of the year. So we'll be covering some of these keynotes from the Fed speaker.
Yep, definitely. So we will discuss what Jerome Powell said and what that actually meant for the market. As usual, today's sharing is for information purposes only and should not be taken to be financial advice. Okay. If you have got questions and you are a SIAS member, reminder that we have the Ask SIAS that's coming up this Wednesday at 7 p.m. where you'll be able to ask Sunny and myself more questions that you might have about the markets. If you find the session that we have today helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can scan this QR code or go to this website. And the membership for SIAS will cost $12 per year or just $1 per month. Okay, so interesting as I was updating this chart that finally we see some correction in the US market. Not significant, it was just a 0.3% decline for the S&P 500 index. And interestingly, the STI actually did better than the S&P 500 last week with a gain of 0.4%. Okay. The big news last week was really the comment by the US Federal Reserve Chairman, Jerome Powell, who mentioned that we are not far from rate cuts. So that actually led to greater investor confidence that we are going to see some rate cuts coming through. Okay, so I went to update the CME FedWatch tool and what it is telling us in terms of investor expectations. So we have a Fed meeting that is coming up in March, 20th of March. And for this meeting, the expectation is that the rate will likely be kept at the 5.25 to 5.5% level. Likewise, for the May meeting, expectation that the rate will not be cut at that meeting. But going into the June meeting, I think that is where the probability of a rate cut is actually now more than 50%. Okay, so currently investors are largely expecting that the first rate cut will come through in June. Okay, so that might be consistent with what Jerome Powell had mentioned in that we might be not far from rate cuts because now we are already in March. And the investor expectations is that the first rate cut might come through in June this year. So in other words, we might just be 3 months away from the first rate cut. Okay. And also quite interesting, if I were to look at what is the expectation for the rest of the year, now the markets are expecting 5 rate cuts this year. If I were to update this chart 1 week ago, then what the chart will tell me is that investors are expecting 4 rate cuts. So now with the comments by Fed Chairman Jerome Powell, investors are now expecting a faster pace of rate cuts in 2024. Okay, so this is being reflected in the US government bond yields as well. If I were to look at the 10-year US government bond yield, we see this fall over the past week, such that it is now just slightly above 4%. Okay, so if you are invested in Treasury bills, Singapore savings bonds, just something to be aware of, because what we see is that the US government bond yield is coming down. Likewise, that is what we see for the Singapore government bond yield as well. Okay, so in terms of the top performers for the STI in the last week, we see DFI Retail Group actually rising by 3.4% after they reported their full year results. We showed a turnaround in its earnings. Okay, Yangzijiang Shipbuilding continues to gain after they reported their full year results and also increased their dividend payout. What we also see in this list is a number of REITs, so Mapletree Industrial Trust, CapitaLand Integrated Commercial Trust, with gains of about 2.6 to 2.7%. So this is in line with what we shared earlier, that US government bond yields are coming down, the Singapore government bond yields are coming down. So that is driving the bounce in the REITs once again. Okay, in terms of the worst performers, we see the Jardine related names. So Jardine Cycle and Carriage, Jardine and Matheson. This really came through after they reported their full year results. And also in this list, we have a number of stocks that we have talked about previously. Seatrium down by 4.2% in the past week. Okay, so what I want to do today is do a recap of the Singapore Bank's earnings. This is a question that we get asked very often around how do I analyze the Singapore Bank stocks? Which bank actually did better in the latest quarter results? So effectively, this is what we see in terms of the share price for DBS, OCBC, and UOB. DBS is the one that did the best after reporting their full year results. Okay, we did the sharing on DBS results earlier. What we saw is that the company raised the dividends as well as announced a bonus issue. Okay, OCBC and UOB share price went up after DBS reported. I think there were also expectations that they will be raising the dividends fairly significantly. But what we see is that the share price actually came off for OCBC and UOB after they reported their results, as maybe the dividend payout was not as high as what some investors might be expecting. Okay, so in terms of what are some of the key takeaway from the results, I think the first point to take note of is that the asset quality of the Singapore banks remain fairly healthy. Okay, so there's a plus point in that because we are in an economic environment which is still fairly decent, we do not see a lot of non-performing loans or defaults as yet. Okay, so across DBS, UOB, and OCBC, we see that their non-performing loans has been coming down. So this is actually a positive sign because the asset quality for the banks would actually be still healthy. Okay, but what has led to concerns by investors, and this is something that we'll keep a lookout for very closely, is actually the net interest margin. Okay, so after the Fed pause on the rate hikes, we see that the net interest margin for the Singapore banks has effectively peaked and in some cases actually started to come down. Okay, so DBS, if I look at the net interest margin, in the fourth quarter, it was at 2.13%. Okay, so coming down for the first time after reaching a high of 2.19% in the third quarter of last year. Okay, for UOB, a bit more worrying. If you look at the net interest margin from 2.22% in the fourth quarter of 2022, down to 2.02% in the fourth quarter of 2023. OCBC has seen more resilient net interest margin. Okay, so in fact, the net interest margin rebounded slightly to 2.29% in the fourth quarter. But if I were to compare this number compared to the fourth quarter of 2022, it is still down on a year-on-year basis. So overall, we see that the net interest margin for the Singapore banks have peaked. Okay, so with the decline in the net interest margin, what we see is that the return on equity of the Singapore banks have started to come off. Okay, so for DBS at 16.1% in the fourth quarter of 2023, lower than the third quarter as well as the fourth quarter of the previous year. This is the same trend that we see for UOB as well, where the return on equity is coming down as the net interest margin continues to decline. Okay. OCBC also, we see this decline compared to the previous quarter. Okay, so I think across the board, we are saying that the return on equity for the Singapore banks is coming off, and that is why you see that the share price performance is stable, but even with the record profit, it is not going up further. Okay, the good news for shareholders is that the dividend yield for the Singapore banks is still fairly attractive. Okay, this especially after they raised the dividend payout. So for the Singapore banks, we see that across the board, the dividend yield is above 6%, UOB at 6%, OCBC at 6.4%. And DBS, because of their commitment to actually keep the absolute dividend per share, while at the same time announcing the bonus share issue. So that would actually translate to a dividend yield of above 7%. Okay, so that is the roundup for the Singapore bank results. Next, I also wanted to touch briefly on CapitaLand Integrated Commercial Trust. We saw that it was one of the better performing names in the STI last week. And also we see that this is driven by the fall in US government bond yields. Okay, what is also interesting to me is that when I was doing my recap of which were the REITs that actually raised their dividends in 2023, there were only 6 REITs that managed to raise their dividends last year, and CICT was one of them. Okay, so that probably explains the fairly resilient share price performance of CICT. But if you look at the past year, it has actually been able to keep stable at about the $2 level, even though we have seen weakness for quite a number of Singapore REITs. Okay, so what is driving this resilience? CICT actually has got a diversified portfolio across retail as well as office. And you see that the bulk of the assets is in Singapore, so it hasn't been impacted by the stronger Sing dollar vis-a-vis some of the other regional currencies. Okay, so what this means for CICT is that if I look at the distributable income for FY 2023, they still managed to grow it, okay? And that translates to a higher distribution per unit of 10.75 cents for 2023. And that would make CICT one of the few REITs that actually managed to grow their dividend payout. Okay, across some of the key operating metrics, we see that they are fairly healthy as well. So the portfolio committed occupancy at 97.3%, okay, an increase compared to the previous year. While some of the other REITs have seen a fall in their property value, CICT continued to see an increase because of the fact that the portfolio occupancy remains fairly high. Okay, they managed to generate positive rent reversion both across the retail as well as office portfolio. So that has also helped to support the property income that has been able to receive. Okay, so that in a way sums up what I've noticed for the Sing market over the past week. In terms of what is coming up in the week ahead, what investors are looking out very closely for would be the US Consumer Price Index data, which is coming up Tuesday, 12th of March, to get a sense of where the latest inflation data is and what this will mean for the upcoming pace of US rate cuts. Okay, we have a corporate connect with UOB that's coming up on Tuesday. So if you have more questions for UOB after the recap that I shared earlier, do join the corporate connect. And last but not least, we have an upcoming 6-month T-bill auction on Thursday, 14th of March. So with that, I'll hand over to Sunny, who will share with us what the latest technical indicators are actually telling us. Over to you, Sunny.
Hey, thanks, Gerald, for that sharing and the comparison on the Singapore banks, which I think will give our members or our viewers a clearer picture of which is the better bank or which one suits their investing thesis better. Before I go into the charts today, I just want to do a recap on the economic data that came out last Friday, especially the non-farm payroll data. Non-farm payroll data actually came in at 275,000, which was higher than the consensus of 200,000 and also above the previous month reading of 229,000 that was revised lower. So it means that the job creation is still on the rise. But then surprisingly, there's some conflicting signals over here because unemployment also inched up to 3.9% compared to the previous and the consensus readings of a 3.7. So I think these two data, these are sort of slightly conflicting kind of data, is actually playing into what Jerome Powell mentioned. We are not too far off from getting the rate cut and also meeting the Fed mandate, the dual mandate of bringing inflation down, but then maintaining their employment high as well. So I think this data is actually a fit into what the description or what the comments made by the US Fed chair last week. Okay, so not a very surprising number, a number that is still quite in line with what we are looking out for. So back to the charts, let's start with the STI Index. So last week we were over here, 4th of March. Today is the 11th of March. So we are saying that the support level for the STI level still seems to be inside this zone over here. And then on Tuesday, last Tuesday, we have sort of a further pullback, but that did not go down all the way to the 3,100 point level, which I think is a bit of a psychological level for the STI Index as a key support level. The lowest we went was at 3,101. So we are still 1 point short. But then again, for throughout the whole of last week, we did not climb or did not rebound very high either. We are still below the red line, which is the 200 days moving average. And if you look at the indicators, right, it's also still not showing that we are going to have a change in trend going upwards or a quick rebound, because the MACD indicator, as you can see, the MACD line is still below the signal line, and the trajectory of it seems to be going in a parallel direction, not an angle of attack that will have a crossover very soon. Okay. So that would mean that although the downtrend momentum over here, you can see from the MACD histogram, it has subsided the downtrend momentum. That means we have the momentum is slightly neutral right now. So we are going to a sideways movement. And if a crossover of MACD happens, then that would signal the start of a change in trend or a change in direction again. Of course, if the MACD diverge away and downwards from the signal line, then the downside momentum might accelerate further as well. So we have to keep a close watch on the behavior of the MACD line and the signal line. On the RSI indicator for the STI, the latest reading is at 47. So that is below the 50-point neutral mark. It means that momentum is very weak right now, below the 50-point neutral mark. And it's also below the slightly above or in line with the 14 days RSI moving average. So that means that it is still, the momentum is more or less similar to what the past 14 trading sessions are seeing. So we are not too concerned, or there's not too much of any surprise now that the STI will move in a very big direction upwards or downwards for now. So probably waiting for the next catalyst before we have the next movement. So I would maintain my previous observation, that is the STI is still likely going to trend around this region. And if it pullbacks towards the 3,100 point level, that could mean it has reached a key support level again, and that could be the key level to watch out for if you want to get into the STI Index again. But just to give a bit of a reference point, I just want to delete this for a moment. You can see that the lower bound of the Bollinger Band, when it breached the previous time on 14 February, that was a good opportunity. So if you want, you can also take this lower bound of the Bollinger Band now at 3,087 points as one of the key levels to watch out for. If there's a breach of this level, that could be another signal that the technical indicators are telling you is a oversold moment, and you can go into the STI Index. As of now, overall, I think the indicators are telling us that STI is neutral. So we will have to wait and see and be patient until the next trade setups develops that is in our favor, or it gives us much clearer clarity. Okay, so I'll put that support range back in again. So that is on the 4th of March, and then we are looking at the 3,100 point level. So this is the zone that we are looking out for the STI Index. Next, let's move to the Dow Jones Index. I think the big news last week was that Nvidia actually pulled back about 5%. Intraday, it actually went up 5% and come back down. So that's about a 10% movement last week on the Nvidia stocks itself, which has added about $1 trillion in market cap value for the stock itself just this year. So this, of course, have a bit of impact on the Dow Jones Index. As you can see, last week we are over here, 4th of March, and then we have a big down day on Tuesday. But then Wednesday, Thursday, Friday was pretty much muted. But of course, we have a negative day on Friday because of the Nvidia movement. So now we are already slightly below the 20 days moving average, which is the Bollinger Band basis at 38,788 points. So market seems to be losing the uptrend momentum right now, or the uptrend momentum is actually losing steam already. You can see that it's very clear the last week development on the MACD indicator. The MACD line is diverging away from the signal line, and the trajectory now seems to be going downwards. So the downward pressure is really coming in on the Dow Jones Index. The RSI is also trending down and have crossed below the 14 days RSI moving average somewhere on this Monday or Tuesday of last week. So RSI now is reading at 52, just 2 points above the 50-point neutral mark. So still a bit of a momentum, but if it crossed below the 50-point neutral mark, the downside momentum will slightly accelerate further. So the next support level, of course, will be the lower bound of the Bollinger Band first at 38,321. Following that, you have the blue line here, which is the 50 days EMA, 50 days moving average at 38,138. So these are the two levels, 38,300, 38,100. This is the key level. I think if the uptrend is going to continue, this is the level that it needs to bounce or find support for. If it's breached, right, then the downtrend momentum would really we have to really look closely into it, whether the rally has really ended for now. But for now, I'm still of the opinion that this is a healthy pullback because we have a rally for quite a few months already. And if it's pullbacks to the lower bound of the Bollinger Band, like what happened on the 17th of January, that would be a healthy sign for an opportunity to get back into the Dow Jones Index for the longer term run upwards. As Gerald mentioned earlier, Jerome Powell has said that second half of the year, we are expecting 5 rate cut according to the CME Fed Watch tool. So that would maybe be the trigger or the rally for the second half of the year that you want to get back on. And these levels are good levels to consider to get back on the rally on the Dow Jones Index. Next, let's move to the S&P 500. Similarly, a pullback on Friday. And you can see that S&P 500 has been consistently using the 20 days moving average or the Bollinger Band basis for a bounce up since the beginning of the year at least. Okay, so the Bollinger Band basis is now standing at 5,060 point level. So we are about 60 points above this level at 5,123 points. So the pullback on the S&P 500 has not really triggered any key levels yet for us to get back into the S&P 500. But key levels that you want to watch out for Bollinger Band basis, 5060. Lower bound of the Bollinger Band is now coinciding with the 50 days moving average, and that could provide a very strong support for the S&P 500 as well at 4,946 points or 4,934 points. So the 4,900 level, I believe, would be a key psychological as well, because the 5,000 handle is where a lot of investors are watching out for to get back into the S&P 500 index. The MACD indicator is not very clear right now. You can see that the intertwining of the MACD line and the signal line does not really show any direction. We will still need a few more couple of sessions this week to tell us whether there's any divergence downwards of the S&P 500, the MACD line diverging away from the signal line downwards. That could mean further downside on the S&P 500. The RSI is showing a little bit of it's showing that it's losing a little bit of a momentum. The reading now is at 62. The average 14 days reading is at 64. So it's coming down a little bit. So do watch out for how the momentum is playing out on the RSI and any directional indication from the MACD indicator, and then look out for key levels of 5,060 point level, as well as the 5,000 handle or the 4,900 level for support on the S&P 500. Lastly, the worst performer among the three indices last week was the Nasdaq Composite Index, the tech-heavy index, dragged down by Nvidia. So a Nasdaq Composite Index is down 1.16% last Friday, or 188 points. Still above the 20-day moving average, and still a key level to watch out for, using the moving average as a key support level for Nasdaq Composite Index. Similarly, key level to watch for on a very important support would be the 50 days moving average, or even the lower bound of the Bollinger Band at around the 15,900 points level, or even the 15,586 points level. So these are key levels to watch. I don't think in the next few sessions, the Nasdaq Composite could hold on to the 16,000 point handle again. So we could be in sort of the intraday trading might sort of bounce on the 16,000 as a key support level. If there's any significant breakdown, let's say a 500 points breakdown from 16,000 level, that will bring us to the 15,500, which is the lower bound of that Bollinger Band. Same thing here, MACD indicator, we need a couple more sessions to confirm any changes or what are the key direction it's moving in. As of right now, it's still quite early to tell, because you can see the last few trading sessions, the intertwining, not really giving us any clear signal from the MACD indicator, although momentum is slightly weak right now with the MACD line below the signal line. Okay, lastly, the RSI indicator is now at 56, below the 14 days average at 59. So it is also trending downwards in the last couple of sessions. So do look out for the RSI crossing below the 50-point neutral mark. That would mean that the momentum is actually coming down, and we could have a pullback towards the 20-day moving average, or even below that for any indication of further pullback in the Nasdaq Composite Index. So these are the key points that I noted on the chart itself. Gerald, what are the final words, or what are the key things that you want us to note for this week?
So I think we are really looking out very closely for the US inflation data. That will probably set the mood for the market over the course of the week and into the Fed meeting that is coming up later this month. So hopefully at the weekly market review next week, we'll be able to provide you with more updates based on what we see in the latest inflation data.
Okay, so I think thanks for that note as well. The CPI data coming this week. That is the key economic data that I will be watching out for. So that is all the time I believe we have for this week. So we'll catch you again next week, next Monday, same time, same place. And in the meantime, trade safe and stay safe. Goodbye, everyone.
See you.